Welcome to a special documentary episode of the Voice of Insurance podcast, produced in association with Stephens Rickard. This is the fourth episode of its kind. The first saw a historic, chaotic, dramatic hard market renewal unfold. At the next, stability and a return to orderliness was craved and was granted. Last year, animal spirits started to be talked of in hushed tones, but it was too early for anything like a full return. This year, the reinsurance industry has its mojo well and truly back. Capital has been fully replenished, profits are real, and there is increasing confidence that they are to a large extent baked in for a time. Surprise multi-billion-dollar loss events have been weathered, and instead of apologising to our investors for poor results, we are still set to report and project healthy profits and returns on capital. Profitable growth is still on the agenda. The real questions this year are of a more philosophical nature. Can everyone grow profitably without changing the nature of the market? Is it better to buy or build? Should excess capital be returned or deployed in M&A? What's different now and what's not? We came to Monaco knowing that reinsurers were likely to have to give a little to get a little. But the question was, what and how much were they prepared to trade in return for a little more of what they really wanted? So join me as I wander the streets, dodge the supercars, cross the squares, and elbow my way through the crowded bars and lobbies to meet a representative cross-section of the reinsurance buying and selling public and find out what's happening in the state of reinsurance. Right, let's set the scene. What's our starting point in the second half of 2025? I opened every interview asking everyone how they would describe the state of the reinsurance market. Let's have a quick run through of 4 or 5 of the most representative opening remarks, and then take stock. We'll kick off with Alex Maloney, CEO of Lancashire Insurance.
I think it's very obvious 12 months on another Monte Carlo that there is more confidence in the reinsurance market. People are looking to grow, and I think that's driven by 2 very good years, and that always helps. So I think the market seems more fluid. I would expect it to get more fluid if the wind season's generous to the industry this year. But yeah, I think the confidence is back. People want to grow carefully. I don't think anyone wants to change all the good work that's been done in the reinsurance market in the last few years. And obviously that was a necessity to drive some sensible returns for investors. But I think, yeah, confidence is here. People are looking to trade and the market seems more fluid than last year.
And now David Flandreau, Head of Industry Analysis and Strategic Advisory at Howden Re.
Well, the phrase that we're using to characterize the reinsurance market right now actually was coined maybe 15 years ago, and it's hard market softening. We're past the pricing peak, which was the title of our January report, as you may remember, and we're in this environment where the market is softening, but there's still plenty of economic value creation happening, and reinsurers have just come through 2 years where they've had very good loss experience. This year's different. With the California wildfires, reinsurers have taken a large proportion of that, but the point is, we're past the pricing peak, but we're not in a soft market. For who dares, you can win, and that's the title of the report, Who Dares Wins.
Of course, we'll have a link to the Howden Re Who Dares Wins report and all the other major Monte Carlo reports in the notes accompanying the podcast. Next up is Christian Dunleavy, Group President and CEO of Aspen Bermuda.
I think we look at it as pretty healthy on the back of a number of years of compounded rate increases among most classes, but one where there is increasing competition and where you need to be pretty targeted and sophisticated in your risk selection and your risk pricing.
A pattern may be emerging here. Time to talk to Charlie Goldie, Chief Underwriting Officer of MS Re. Charlie is someone who's been a regular on this Monte Carlo special and has seen multiple market cycles play themselves out.
It's an interesting time. Yogi Berra said it's deja vu all over again. And I think we're seeing a typical reinsurance market cycle do what typical reinsurance market cycles do. Everyone draws the sine curve when you talk about a cycle, but the reality is it's 2 or 3 years sharply up and then 15 years slowly down, and the death by 1,000 paper cuts. And I think we're past the peak. We're starting the slow phase down. As you walk around Monte Carlo, you'll run into heads of reinsurance operations, and they'll all tell you, based on where we are today, I'd like to grow my business. And there's the asterisk, which is the based on where we are today. And I think there's not a ton of appetite for growth that anything much worse than we are today. But at current terms, almost every reinsurer seems to be looking for growth. And I think that's when I say cycles are doing what cycles do. Nobody really wants to go crazy and massively cut price, but people will give slight improvements here and there in exchange for the opportunity to grow. And so you start that long, slow slog down.
I always enjoy time spent with Charlie. Here's another regular guest who's a long-standing market player and whose insight I always value. Simon Bird, Group Executive Underwriter at Brit Insurance. Let's see if this emerging picture is going to get even clearer. Simon, how would you characterise the state of the reinsurance market at the moment?
Right now, I would say in a fairly healthy place, in a stable place. The major players know where they're at. They've probably done a lot of curation to their books in certain areas, particularly casualty, when you consider how much particularly proportional casualty has been dumped in the last 2 or 3 years. And that adjustment process has gone through. I think people are broadly comfortable with their portfolios. So we're plateauing in a good place, which begs the question, where next, or with the market?
Yeah, I think the last time I spoke to you, we'd be talking about bumping along the top. Every CEO of a reinsurer that I talk to would like to carry on growing, would like to deploy more capital, with a tacit acceptance that some of the rate might be coming off, but with an understanding, deep understanding and happiness that the underlying adequacy is still there and going to be there. Can they all grow in the way they all want to at the same time without changing the nature of the market?
They can't all do that because this market, in terms of margin, isn't perfectly scalable on a linear basis. If you increase the supply by 30% and the demand is only going to grow by 10, QED, there's going to be pressure on pricing. So I think if you're an informed player with good pricing discipline, good ability to truly measure your rate adequacy, and you've got a good underwriting service proposition, then there is room for disciplined growth. But the key is that word disciplined, if you like, because we are in an area where many classes are now patently coming off the top, which doesn't mean they're underwater, but we have to be eyes wide open. We have to be absolutely, as an industry, insurer and reinsurer, aware of where we are and how far down we can go and beyond which no further.
Well, I hope you're enjoying the ride so far. One more underwriter and then a check-in with a major broker, and it will be time to draw breath and take stock. It's all becoming pretty clear. The underwriter is Martin Burke, Chief Underwriting Officer of MS Amlin.
I think for our part, if I talk about MS Amlin briefly, the MS Amlin trajectory into 2026 is actually a relatively stable, consistent book year on year. And part of the thinking behind that, to me, is that if you think of the level of placement on programs this year, let's say it's 130% place on average for programs. I'm never entirely sure about those percentages, but given where this year might end up, even with a large event at the start of the year, you'll have more retained earnings, you'll have more capacity, and there seems to be plenty of capital out there ready to reload and redeploy. So the placement is likely to be higher in terms of the previous percentage. That means it is going to be fundamentally quite difficult to achieve both things, to have a capital-rich and capital-improving industry, and yet somehow still achieve more business, because the amount of growth I think that we've seen in the last year or two in terms of demand for capacity, I don't see so much of that coming through in 2026.
So it's an inflection point, so you're much more having your foot on the brake than on the accelerator at the moment?
I suppose it depends a little bit on the part of our portfolio. So it's a mixture of brake and accelerator, but the overall net effect for our total syndicate number is a stable picture going into 2026.
This episode is supported by Stephens Rickard. Stephens Rickard Limited is an executive search firm with offices in London, Miami and Zurich, and a specific focus on the global insurance and reinsurance markets. Their deep appreciation for the markets they operate in, assessment methodology and exceptional track record of completion really sets them apart. The team's dedication to searching beyond the obvious, the D&I synopsis reports they produce, and their obsession with doing the right thing by both clients and candidates is demonstrative of their enthusiasm for improving the businesses of their clients and the careers of their candidates. To find out more, head to stephensrickard.com. Now for a quick word from David Duffy, President, Global Clients at Guy Carpenter.
I think this conference has been one where there's probably not been too many surprises. coming in terms of messaging from reinsurers and insurers. So we overused orderly in the market to describe it in 2024. I think this is very much a managed series of rate reductions that we're seeing in many lines of business as we start looking forward to 2026.
I can certainly remember compiling a memorable audio sequence of executives calling for an orderly renewal at 1/1/24 as a reaction to the fractious and sometimes chaotic reset renewal a year earlier. So, time for a breather and a recap. Reinsurers are confident after a couple of good years and having demonstrated their newfound ability to absorb the sort of loss events that might have overwhelmed them just 3 years ago. They would all be happy to grow into what they see as a profitable market, but the savviest know that they can't do that without giving something in return, and that, as a consequence, the market is likely to soften, albeit from a position of great rate adequacy from here on. The question is how aggressive reinsurers want to be in their attempt to capture as much of the good part of the underwriting cycle as they can. Should they dare and win, as Howden Re might want them to, or should they be putting on the brakes, hanging on to as much of what they've got as they can, and prepare for Charlie's long, slow slog down? What's clear is that reinsurers know that at 1/1/26 they have to give something to get something. Simon Bird noted that service levels and propositions are going to come into focus. 3 years ago, reinsurers could segment and differentiate the market by the quality of cedant. But now this is the other way around. This is clearly a great market for buyers. So my next step was to ask the brokers how they were managing client expectations and what their clients were most looking forward to as the end-of-year renewals come into view. Let's go back to David Duffy.
You're going to see some different responses from individual clients, and there's certainly going to be some who are happy to take the money and run. I think actually you're going to see quite a few clients look to address some of the gaps in coverage, the things that they were frustrated they couldn't get over the last year or two. So I'm very much a property practitioner. In the property space, frequency cat coverage, as you may have heard, is going to be the order of the day for many clients.
There will always be clients who simply take any reinsurance discount home with them. But there was definitely a sense that many cedants will use their savings to buy more cover and try to fill in what they've had to cut back on in the past 3 renewals. The return of frequency covers was a big talking point. Here are some quotes from my chat with Richard Dudley, Group Chief Broking Officer at BMS.
I'd just like to see the industry being a bit more imaginative. And I know there's a lot of talk here about the return of aggregate covers. We've seen a number of those already this year. Yes, I expect we'll see more of those, but I think even though the concepts remain the same over the decades in terms of the type of structures we have, the way they can be applied, the certainty of their efficacy based on data analysis is much more accurate now than it ever was. I'd like to see them using those growth ambitions in a smarter way. I'd like them to think about different structures. There are so many more interesting ways to think about earnings volatility now than perhaps there were, again, powered by data and technology, which we've never had before. And so I think there's an ability to grow without necessarily just having to reduce rates on the large standard programs that will be bought year after year.
A good broke from Richard there. These days, tech investment should be turning ag covers from what used to be a bit of a blunt instrument into a much better calibrated tool for equitable risk transfer. More on that later, but here's a great opener from Lara Marary, Chief Commercial Officer of Gallagher Re.
I feel like it's a little bit of a unique state in that we do have capital that people want to deploy, but returns are still actually quite attractive. So there isn't really a reason not to deploy it at this point. And that's going to allow for reinsurance brokers and clients to really focus in on, I think, having a little bit more creativity this renewal season, thinking about what it is that clients maybe really need from a coverage standpoint. A lot of things have changed in the last couple of years.
The words creativity and innovation cropping up again. And I love the idea that reinsurers really don't have any good reason not to deploy capital at these elevated rates of return. Now, back to the aggregate cover question. According to Laura, after 3 years of retaining and managing this part of their portfolios, these are now risks that the well-run cedants now understand in a much more granular way than they used to. And as their re-underwritten books start showing results, they should be able to get more credit for their work.
The degree of work that insurers have done in the face of really dramatic changes in the reinsurance industry is now coming through. Reinsurers can turn over their portfolio and the dynamics of their portfolio pretty quickly you can go through one renewal season as a reinsurer and make really substantial changes to the way that you're offering coverage and the way that you're pricing a product. Whereas the insurance company feeling the effects of that has to go back through an entire process that takes 18 to 24 months to really work its way all the way through. We're at that point where, if we just take property and casualty as examples, there have been substantial changes in underlying policy health on the property side and on the casualty side. And reinsurers are wanting to dig into more deeply exactly what that looks like and then understand that in relation to the product they're going to offer.
The point about reinsurers being more manoeuvrable than insurers is a good one that is often missed. The best cedants are going to be sharing all the insights they have learned with their best reinsurers, and those reinsurers may indeed be pleased with what they see. Over to Alex Kazanjian, partner and managing director at Augment Risk.
We had a great conversation with one of the markets this morning. They were extremely interested in exploring further aggregate covers because most of the cedants have to purchase their insurance, again, in the typical silos of products that are sold in boxes, differentiated only on price. But when you can focus on an aggregate cover, they're able to get a far better value for the outcome they're looking for.
There are clearly trades to be done, and this is obviously where a lot of the action at the margins is going to be. And because the market is more fluid and more confident, perhaps more action is to be expected. Back to Charlie Goldie.
We're happy to engage on a conversation of, can we lower our attachment point? The trade has to be well priced, but the real trade is show me what you're doing to manage those perils. Over that 15-year period from the late 2007, 8, 9 to 2022, when attachment points stayed flat, those perils became more and more unmanaged. And so really understanding how a company is managing their flood risk, how a company is managing their convective storm risk in the U.S., what have you done? How have you changed your portfolio or your risk management process so that by reducing the attachment point, we're just not backing up to where we were? That's the interesting trade. If you can show me what you've done, then we can have a really interesting conversation about adjusting the attachment.
More information, better modelling and better understanding of risk on both sides has to be an enabler of more confidence, and more confidence should lead to more transactions. Here's a telling exchange with Craig Darling, partner, MD and Executive Vice President at Acrisure Re.
We sold many covers that were cascading type structures that were really in the essence functioning as aggregate covers. The market isn't going to repeat that scenario, but I think there will be coverage offerings if you're willing to pay for those protections. And I think the exposure information, the integrity of the information, also the integrity of the models have a different viewpoint now on a go-forward basis so that people are making more informed decisions around those offerings. At the end of the day, people are willing to offer certain unique product offerings. They just want to make sure they're getting the right price for it. And I think the technical and exposure details are more readily available so people can make better informed decisions from a technical pricing standpoint. One of the things that has changed is that the companies now have more appetite to take risk. They were forced to take more risk, so they themselves had to dig deeper into the exposures of their underlying business. And when they've done that, they obviously were extracting better details, better information, obviously doing a better job in presenting the exposures to have that modeled, which obviously that would cater to better detail for the reinsurance markets if they were willing to share some of that exposure.
So we're getting somewhere here. But this isn't something that everyone is contemplating. Some, like Paul Brand, CEO of Convex, have a more philosophical objection to reinsurance as a form of earnings protection.
Why would you be seeking earnings protection? Well, might be a more...
Well, earnings volatility protection.
But do you really get what you pay for? Clearly, if you can get earnings protection and people are mispricing it and they're essentially subsidizing your earnings, well, yeah, I mean, that's not a bad product to buy, except for it's never very sustainable. And if you get yourself hooked on it, then that could end up altering your gross underwriting, and then you're in a very strange position. But you should really be thinking about how do you use reinsurance to protect your downside risk and make your business more resilient, as opposed to where that switches through on attachment points and how that plays into capital management and how you think about quota share as opposed to excess of loss. They're interesting questions, but earnings management as a topic of its own, you're ignoring just tons of the...
It might get in the way of good underwriting.
Might very well. There's the famous Monte Carlo sketch, isn't there, when the person turns up with a train and then the guy goes, "Why have you got a train? It's a bargain. You only should buy stuff if you need it."
Some wise words. Maybe earnings volatility is a symptom of an imbalanced insurance book, and therefore a core insurance problem to be addressed, and not something that reinsurers should be asked to take away. But as long as everyone knows what they're getting into, and the scope of cover is defined very carefully, most underwriters recognise the value of the product. Here are a couple of quotes from James Slaughter, Chief Underwriting Officer of Apollo Underwriting.
So I think aggregate covers pitched at the right level, pitched in the way in which both parties understand the perils and the drivers of risk within them. They're a valuable tool in the buyer's toolkit. I don't think the industry would be walking down into a sort of all perils, don't worry what it is, it's covered type aggregate structure that we might have seen in the past, because I think the industry's probably learned a few lessons in the last 10 to 15 years. Part of the partnership we have with reinsurers is we help understand each other's exposures. We learn from our reinsurers and the way that they look at our portfolio are the things that we're missing. That's one of the great elements of a strong partnership with your reinsurer. Certainly as a reinsurer for our book, we try and provide that insight and intelligence back, and we hope it's useful. As a buyer, we certainly go to our lead reinsurers, and if they observe something or they feedback something, we want to take that information in and learn as well. So I think if you take it through that lens of the industry improving and the knowledge sharing that we get with our partnerships, then yeah, you would be super clear on what is covered, and then a transaction like an aggregate transaction is very feasible. If you can analyse it and you can justify it and you can put a price to it and you can satisfy both sides of the transaction, that you've got a logical approach to it, I think you can go and buy the coverage you want. I think it comes back to, can you get to that data? Have you got the data to support it? And can you reach a fair price for it? I'm not expecting, nor do I encourage, quite frankly, reinsurers to go and have the bonfire of the T&Cs just to win some business. That's madness. And that is the boom bust that we've seen in the past. And that's what I don't know, somewhat optimistically, I guess, hope that we've matured as an industry.
So if we do this in a grown-up way, avoiding bonfires of terms and conditions, T's and C's, and any of the madness of soft markets past, there's going to be appetite on both sides of deals. But for others, it's still too early for this kind of talk. At this stage in the cycle, Alex Maloney is pretty clear in his view.
Again, when you look at how markets soften, in my experience, it starts with rate, it starts with premium, and eventually it gets more difficult. So I just don't think we're there yet. So I think if you went in and you were super aggressive on attachment points or earnings coverages and all the things that we've seen in the past, I think that would be very difficult at this stage of the cycle.
And Rachel Turk, Chief of Market Performance at Lloyd's, has a different take. The dialogue is likely to happen, but the consensus on the sort of pricing that makes both buyer and seller relatively happy might not yet be there.
That's definitely a theme that's resonating around Monte Carlo this time round, of aggregate covers, and there's a level of nervousness of going, well, they didn't work last time round, so what's going to make them different this time round? And you're absolutely right, the re-underwriting, maybe being a little bit more aware of the risk that's going in there that might make these slightly better than they were last time, put it that way. I think time will tell whether there really will be demand for those, whether they can be priced at a level. I think if you truly understand your risk, then there's a price at which somebody will take it on, or otherwise you're determined to keep it net. And there's probably at the moment an imbalance between quite how well maybe the cedant thinks they understand the risk versus perhaps the reinsurer's appetite and their knowledge of the risk. So you might not get optimal pricing.
Yes, we're not going to get to market consensus where both can pull the trigger happily buy and happily sell.
Not yet, I don't think.
So we may have to wait for consensus to materialise. Perhaps reinsurers' memories of picking up secondary peril losses almost every quarter before the Great Reset are still too fresh. As David Duffy reminds us, gains on attachment points were hard won by reinsurers, so you might expect them to fight just as hard to hang on to them.
Any reinsurer will tell you the biggest gain they made in the 23 renewal cycle was retention increase on property and elevating out of frequency cat. So that is, for many insurers, the big need that is unaddressed going into 2026. So undoubtedly there's going to be friction in terms of where that supply-demand balance is struck on some of these frequency deals. But I do believe there's a willingness on the part of reinsurers to try and find solutions.
Where there's a will, there's a way. I think that's the whole picture for the great aggregate cover, attachment points, earnings protection debate. Those with the best data and analysis and the best understanding of risks are going to be able to have a very reasoned debate with the most confident reinsurers. But a return to all-purpose, all-perils type covers seems unlikely for now. Time to check back in on a familiar friction point of reinsurance renewals past, the US casualty and more specifically the US liability reinsurance space. I asked if, being another year older, with prior year reserves another year more seasoned, and notably in the absence of any new bad news or unexpected deterioration, whether abundant caution might start to lift a little and reinsurers' appetites return. Time to hear from Clemens Jungstoffel, CEO of Hannover Re.
I think compared to previous years, we are seeing some improvements in more recent underwriting years, driven by rate increases and tighter limit management. So that is encouraging, I'd say. However, underlying trends do remain elevated. And one question is, whether there is probably an abundance of caution in reserving for newer years, given the negative experience prior to 2020. And then the disruption, of course, caused by COVID-19 further complicates the picture because frequency data is difficult to interpret due to lockdown-related slowdowns. And then you have the post-lockdown catch-up effects and broader trend shift. So unfortunately, Mark, it will likely take a few more years to get a clear indication of where things are headed. And despite some positive signals, it's still too early to confirm that recent underwriting years will ultimately hold up well.
No big change in sentiment there. Perhaps an end to cooling, but certainly not a warming. And here's a fresh view from Duncan Dale of Dale Underwriting Partners.
We see a lot of deals that we said no to a year ago, 2 years ago, and when we look at the data that they're presenting for their renewals now, quite often they're worse than we thought they would be. And so someone's got all of that data running through their loss ratios. And so when we look at that and we analyse that volatility in what's typically an excess of loss play on the casualty reinsurance, we feel that that volatility needs a higher margin quite often than is being presented. If it's worse than we thought it was going to be a year ago or 2 years ago, that sort of demonstrates the volatility there. The natural conclusion of that should be that the terms or the structures need to continue to improve.
So the verdict ranges from too early to say to definitely could do better. I wonder what a major broker and a big client advocate has to say to that. Here's a couple of quotes from Lara Mowry.
The attitude towards casualty remains pretty watchful. And I completely agree with you. We're another year smarter. We have another year's worth of data. But the way that data is developing out, there's not consensus around what it means because potentially development patterns are happening in a bit of a different way than they were happening in the past. And so you have to find common ground. You have to find agreement on what that means for ultimate numbers. Is 2022 profitable, not profitable? There's not agreement. Is 2024 profitable or not profitable? Nobody really has the answer to this yet. So have the adjustments come through, and are they enough? Casualty continues on the primary side to look at where it needs to adjust. That continues to come through. So on the reinsurance side, are we at a place of healthiness? Verdict is still out. We've done a lot of research around this and have done a lot of work with our insurer partners and our reinsurer partners to understand how the dynamics are changing to try to better figure out where we are. We think we're closing in on turning that corner and actually seeing the dynamics playing out more favorably going forward, but still some caution around how reinsurers are going to respond.
So you'd be very unwise to be giving bullish signs to your customers.
I think that's right.
In a market where brokers are generally more bullish than they have been for some time, Lara's tone is notably more cautious. I wondered if Richard Dudley would be more optimistic. Do you think reinsurers will be warming to the class a little bit more than they would have otherwise been? Although probably with the caveat that there's always a cautious warming.
I think it always is a cautious warming anyway with US casualty, and I think if you go back far enough, it's always been like that. I think for me, the interesting thing to note about the challenges we've seen in previous underwriting years is that they haven't necessarily been driven by a new issue. They haven't been driven by a new loss class. There hasn't been a new asbestosis or something like that that's appeared. So a lot of the causes of those reserve deficiencies has been some form of inflation, including social inflation, of course. And so that's the big shadow for me, is possibly the litigation funders, but probably more significantly the nuclear verdicts that we see in courts and the impact that has on social inflation of claims. So if that continues, that will continue to add an element of caution to the marketplace. If it doesn't, we might see more and more people getting interested in the class.
Richard wisely not taking any of my bait. It's clear that the consensus around US casualty is that there still isn't really any consensus. Here's David Flandreau to give us a more analytical macro view.
This is a very top-down view of casualty, first and foremost. I'm an analyst. I'm not an underwriter or even a placing broker, so please understand that. But we all remember the liability crisis and how painful it was. It was very sharp and acute. I was just, even now, looking at the other liability occurrence line in the U.S., and you can see that the loss ratio gets up to, I think, 110% for the whole industry at its worst, and that doesn't even include comp. So it was 4 years, 4 accident years, and it was extremely acute and extremely painful. We lost a number of carriers who went into runoff, and that is in the institutional memory of the sector. In fact, that's why we have so many redundancies in the 2000s following that, because there was a lot of fear, and people were very careful about what they did. You may remember that we wrote a report back in 2016 called Enough in Reserve. In that report, we talked about how the cycle was starting to change again. And indeed, if we look now from accident year 2013 all the way up to, if you want, now, general liability reserves have been deficient. But this is a much longer cycle, and it is also a shallower cycle, or at least it has been so far. Again, I want to be respectful and not flippant of the underwriting, but it's a longer, shallower cycle. I don't know too many big companies that have gone into runoff during this period, and there are offsetting factors. The first one is interest rates, but that was also the case in the 90s, and we don't want to get pulled into cash flow underwriting. But the second one is that on a calendar year basis, reserves generally, worldwide, remain a source of profit. That wasn't the case during the last deficiency cycle. And that's because we have redundancies in comp, we've got redundancies in med-mal, there's redundancies in specialty and short tail. So are we in the cheating phase? Are we stealing from the cookie jar? It's possible, actually. But the big question for me is, how long and flat can the cycle be, and at what point does it again change in the future? And I think you can make money underwriting in casualty. I don't think you should blindly jump in with both feet, clearly. But again, if you're someone who knows how to innovate, to use technology, who has a competitive or comparative advantage, the casualty market's so broad anyway. Casualty is such a big class. If you know how to risk select, rates are still elevated in many lines, and some of them are continuing to go up. The reserve remediation that started to take place began in the 2020s with higher levels of first-year IBNR in many different classes. So yes, I think if you can risk select, casualty remains a very attractive class, including for reinsurers. That said, we are in the deficiency phase of the cycle, particularly in U.S. casualty, so proceed with caution.
That was pretty comprehensive, but the message was clear. The same analyst whose report is telling us that those who dare in this kind of market will win is urging caution. Indeed, the main enthusiasm for casualty is still to be found in the legacy and alternative ILS sectors. Over to Alex Kazanjian.
That has been an area where there has been a significant amount of interest from the ILS market, and specifically there have been many casualty sidecars or ILS-related deals related to casualty. So from a difference of development, that will be interesting to explore in the next 2 to 3 years, because there are a lot of structured reinsurance transactions we can do from the legacy point of view. So structured retrospective to remove some of these liabilities that people have had to either over-reserve or have funded through higher interest rates. I think the next year or two will still have a lot of opportunity in it, but then everybody would have either over-reserved or interest rates will be coming down, so it won't be as palatable to hold them on the balance sheet.
So real interest rates do help, and there are still places to go for solutions. but clearly for more seasoned years. Now let's change the subject. The reinsurance industry has recapitalised nicely, mostly from retained earnings. So, if we're past the peak and growth is going to be a little harder to come by from now on, what should insurers and reinsurers do with their surplus capital? Should they give it back to investors, or should they deploy it in taking over their competitors? We had already seen some M&A announced before the conference kicked off, and more was to come, albeit these were strategic acquisitions of Lloyd's vehicles from those looking to gain entry to the market and less about market consolidation. But was this a sign of a new wave of M&A to come? Let's take a poll. Starting with Scott Egan, CEO of SiriusPoint.
It's our duty, my job as a CEO, to deploy capital and effectively try and make the right level of return for our shareholders. If you can't, then I'm quite agnostic as to what the different mechanisms are for the uses of that capital. It can be returning it to shareholders. We're already starting to see some of the early shoots of M&A in the marketplace. So I think there are other options for capital deployment, and actually I think those are better avenues than driving pricing levels down to a rate that don't match the risk.
Scott being typically level-headed there. Keeping returns where investors want them to be, via any means, is preferable to excess competition driving pricing too low. Now let's hear from Richard Brindle, Chairman and CEO of the Fidelis Partnership. What do you wish people with balance sheets would do with their excess cash?
Well, I think they should return it. I mean, when I was running Lancashire, we pioneered the concept of the special dividend, and it was enormously popular with shareholders and has since been widely adopted by others. And the premise of that was, if you've got excess capital and nothing to do with it, give it back. And I'd like to see more of that.
A straight and unequivocal answer, as one would expect. Here's Waleed Jabshir, CEO of IGI.
For me, if there's the most important thing, do not put yourself under pressure to deploy that capital. You do not have to if you don't have the right opportunities to do so. You can always return back to shareholders, wait for those right opportunities, and then deploy it when you need to. As a company, IGI, we've always said our philosophy, underwriting first. That capital is used to deploy into the business, into growth opportunities. And when markets are not conducive for that continued profitable growth, then, there's various ways of getting it back. As a public company, we can roll out a buyback program, which we as a business have been doing so for the last 3 years. You can give back in dividends. Use that capital wisely. Be sound stewards of that capital. Don't put yourself under pressure to deploy it, because that's when the soundness of your decision making can be jeopardized.
Another who tilts towards giving money back rather than forcing yourself to do things with it. So, capital returns are where the head leans. But here, Alex Maloney makes a good point about logic and business decision making.
I think whether it's logical or not, I think that's what's going to happen. If you look at prior cycles and you look at where M&A happens, it's when the market softens. We've seen, 3 deals in the last few months. So I would expect to see more M&A. I think it's going to be hard for people to grow. And if you do materially want to grow, that is obviously an avenue for you. And there's obviously a number of carriers that are privately owned that are coming to the end of their ownership period with their current owners. So I definitely think you're going to see more M&A as the market softens. I think that's pretty obvious.
It seems it's just the way of the world that we'll get M&A whether we want to or not. Alex also makes a good point about ownership. If you founded and scaled a carrier during the harder market years, now looks like a pretty good time to start a sales process. More on this from Rachel Turk.
I think it is logical that we'll see more M&A for a number of reasons. You have a number of businesses out there where you know that their capital provider may be looking for a strategic exit because of the time horizon on which they will have invested in the first place, so that will naturally lead to some form of M&A. You have non-UK based global insurers who have strong balance sheets, and they will look at M&A as a way to grow because potentially their domestic markets aren't giving them the growth that they would be looking for and looking to deploy. So I do think we'll see more M&A as we go through this year and into next.
So the timing issue for current owners is as important as the state of the market. David Duffy has another good point to make here. It can be better to buy than to build.
I think if you ask any insurer or reinsurer, they'll say that a seasoned book of renewal business is always going to perform more predictably and likely better than new business. So to me, we're at this wonderful point in the market where folks are looking for growth. They still see rate adequacy out there. It's almost a safer bet to buy somebody else and take their seasoned book of business than to stretch yourself and try and do it organically.
If an insurance company is an underwriting franchise combined with reserves, then provided you're comfortable with the strength of those reserves, then taking M&A on can make a huge amount of sense. So M&A looks very likely to accelerate from here on as natural acquirers look to buy and expected sellers look to realise gains. It's time to take a small detour. One of the great things about this conference is that it's not all about headlines and quotes. This is one of the few annual events that gives you the ability to meet with all sorts of contacts, some directly involved in the cut and thrust of reinsurance renewals and plenty who are not. For instance, there are some carriers like Mapfre Re who are major global reinsurers in their own right and huge buyers of reinsurance. But they really aren't here to get coverage in the conference dailies. They're happier out of the headlines and are here to deepen some very long-standing relationships as a buyer and as a seller. I really enjoyed meeting Mapfre Re's new CEO, Miguel Angel Rosa. It wasn't a meeting full of headline quotes, but it was extremely valuable. Here's a typical exchange. How would you characterise the reinsurance market of today?
What I would say is that basically we have a stable market, we have a strong market, and with very solid balance sheets.
You're a big buyer, but I know, of course, you're a big seller too, almost a unique position. Something, as a buyer, do you think this is a market where you're going to be able to get better value? And then if you think you will get better value, what will you do with the extra value? Will you put the savings in your pocket, or will you buy better quality or more?
This is a very good question, because in our case, our strategy is usually of a very long-term view. So we don't trade with the different status of the cycle. So in our case, this is not going to be a huge difference. Probably our placements will be easier. There is more capacity, and when reinsurers are making money, everything is easier. But I mean, I don't see major changes.
You're not the sort of buyer who changes their panel just to improve a few points here or there?
No, not at all, not at all. In fact, we really believe in these long-term relationships, and when you see our panel of reinsurers has been super stable for years.
So, as a buyer, you're just going to increase the quality? Would you be buying a bit more? For example, in the last 3 years, obviously we know the market has been more difficult for buyers. Now the market is a bit more flexible, more liquid, more competitive. What's your strategy? Will you be buying more and then looking for more frequency as well?
Yeah, I mean, what we do as usual is to explore different opportunities and different products available in the market. But in the end, I would say that the key is to protect the capital that Mapfre is putting to Mapfre Re and to give the adequate return. So as you know, our strategy, very, very short, is to be consistent in terms of results. So in fact, in very good years for the industry, usually we are a little bit worse, okay, because we protect ourselves more. But in bad years for the industry, we always perform better.
This is really what Monte Carlo is all about. Meeting old friends and making new ones, and reminding yourself of what their risk philosophies are, and what has, and in the case of Mapfre Re, what hasn't changed. I must get Miguel Angel on the show soon. I also had a wonderful meeting with Jerome Hagley, who's the chief economist of Swiss Re. Jerome's job is to zoom a long way out, way beyond almost insignificant milestones like annual renewals, and look at the really big picture. It was good food for the mind, and the thrust of what Jerome had to say was a great tonic for any reinsurer feeling a little sad about the market turning.
It's a super dynamic reinsurance market, no question about that. Actually, we just released our Sigma report, and we really look at that question. How is the reinsurance market today? How is the P&C market today? And we look back at the last 20 years, 2 decades, a long time period. A lot has changed. Number one, you see actually more demand for reinsurance, more demand for risk transfers, a renaissance for reinsurance. We see actually that the premium growth for reinsurance is almost double the amount of direct insurance market.
Yes, I saw the headlines that were on the reporting projecting a growth rate of doubling in size by 2040. What is the compound annual growth rate on that?
It's about 7%.
That's pretty good, isn't it? It's better than what projected GDP is. This is
exactly, yeah. But it's higher than overall. The market is running at a higher rate than global GDP. That is good news, right? It means that protection gaps remain in check. It means that there's some hope for narrowing protection gaps. It means insurance is working. And on top of that, you have more demand for risk transfer solutions.
That's great long-term news for all of us. 7% compound growth for the next 15 years should make our industry more economically relevant and keep all of us gainfully employed. It will also make excellent use of any excess capital we generate along the way. But of course, this wasn't a headline you tended to read as you walked around Casino Square. So you see my point about Monte Carlo being a useful experience and a far broader church than you might think. I'm going to add a link to the Sigma report in the notes. It's time for one last dip into the melee around the hotel lobbies and cafes. To sign off, I asked what kind of insurance and reinsurance news headlines delegates would like to wake up to on the 1st of January 2026. Let's get Charlie Goldie to kick things off.
There's a piece of me that says I'd like it to just be boring. I think boring is good in this business. So I'd love to see a horribly boring renewal. Selfishly, I think MS Reinsurance has a lot to sell to our clients, and through a boring renewal, we'll outperform because we'll get more of the business in a boring market. There's a selfish piece of me that looks and says I'd like a little chaos. I don't know what kind of chaos, because I think we can excel in chaos. And so I guess the answer, Mark, is I don't really worry about it. I'll be okay if there was chaos. I'll be okay if it was boring.
And now over to Rachel Turk.
Almost an absence of headlines would be good, because the level of stability, what would be great to see is it was almost like stable, nothing to see here, same as last year. It's all just been a very orderly renewal season. That would be great, because I think it would be really valuable for the insurance industry and the reinsurance industry to have a little bit more period of stability rather than swings in price or terms and conditions, coverage, etc. So no news is good news is what I would almost like to see.
And now Duncan Dale.
Boring would be good. I think a stable supply and just a straightforward renewal, I think, would be fine.
Boring is very much in vogue. It's perhaps logical that when asked for what they wish for, people whose job it is to deal with volatility will always crave stability. Over to Waleed Jabsheh.
I mean, the headline that I would hope for was stable renewal season. At the end of the day, everybody being treated fairly, good clients being treated the way they should be treated, and those that aren't pay for the records that they've achieved.
So a fair and just renewal too, where everyone gets what they deserve. Let's give Miguel Ángel Rosa the last word.
I would love to continue seeing this stability that we have in our industry. And let me explain myself. We are living in all of this uncertainty world, with all of this macroeconomic, geopolitical uncertainty, climate change, all of these things around. And our industry still is very resilient. So this is honestly the headline that I would like to see, that everything continues as it is right now. And what we said at the beginning of the interview, that we see a kind of a boring, if you wish, environment.
So, boring has it. Thank you to all of my 22 interviewees this year for your valuable time. I'm sorry I couldn't use more of all your interviews, but that would defeat the object of this documentary-style podcast. Also, thanks to the RVS team for hosting another excellent event. We never thank them, and we should. In fact, we all love complaining about this event, and foolishly take the amount of organisation going on behind the scenes for granted. Thank you so much also to Stephens Rickard for its continued support. A production like this wouldn't be possible without them. As the market continues its slow turn, I wish you a boring rather than a bruising renewal. And definitely no long hard slogs. Let's speak again in 2026. Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this programme. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you know you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry. Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.